Shall we start?
So may I interrupt you for a moment?
Sure.
Where can we find these slides? Like, as in, are there any tools we can download?
These slides handouts, it's available. If you join the Google Classroom.
Okay.
You will see these messages.
Okay, sir.
So see, this is a this is a presentation.
All right. Okay, sir.
Likewise.
Okay, sir. Thank you, sir.
You can find even the video.
Okay.
This is the video last week.
Okay.
So I posted a survey. I think there was only 16 responses. If you can respond it now.
So there is a issue with that survey because we don't have the permission. The file asks to permission to fill that form. That's the reason.
Sorry, can you log into the classroom? Those who have not access for the permission to fill the survey.
So excuse me.
Yes.
And also they can download the tutorials from classwork.
Classwork, yes.
The next, yes.
Here also, yes. Having any reason that they said they cannot fill the survey, they don't have permission.
So I think they try to log in through the Google Classroom, sir. There is a problem, I think.
That's the problem, no?
Yes. When they log in the classroom through the Google, that means our email, using our email, they can do that one, sir.
Do that. They have used their Google account.
No, they are not personal ones, sir. That the IBSL one.
Yes, yes. I mean, those who have tried through their Google, Gmail accounts only, they cannot access this. But if
Yes,
they have been using the domain ibsl.edu.lk,
yeah,
they should be able to fill this.
Yes, sir.
Thank you. So please try to fill that. Any other question, please, before we start? Any other questions? Okay, if you don't have any questions, we'll start the session. Can someone summarize what we discussed last week? What's the topic that we discussed?
Basically about the financial markets.
Basically, financial markets. So what are the things we discussed? First, we discussed what is the, before that we discussed what is the, as an introduction, we discussed what's the role of the bank and within a bank or a financial institution. What is the role of a treasury? In the very brief introduction. Then we move into financial markets. What are the things we discussed there?
Types of financial markets and their functions.
Yes. So we were discussing what are the characteristics of a good market? What is a market? What are the characteristics of a good market? What do we expect, or what is the function of a financial market? Then types of financial markets, or we segregate financial markets into different categories based on the product, or maybe the product, maybe the maturity, maybe the use of it, or maybe the volumes, and based on the organization. Likewise, so we just name them as based on the maturity. How do we segregate them? Money market and capital market. Then based on the nature of the assets traded, debt market or the equity market. Then whether you create new assets or you trade existing assets. That is, if you create a new asset, that's in the primary market. If you trade existing assets, that's in the secondary market. Then what, based on the delivery method, whether you deliver any product or cash, or it's just a derivative in the organization, whether it's through the organized exchange or just the over-the-counter market. Then based on the volume, whether it's wholesale or a retail market. And I mentioned here we mostly focus on the wholesale market, because in treasury you deal with wholesale, you deal in wholesale market, not in the retail market. So if you move forward with little bit more detail about this classification, first we'll take the money market and the capital market. Based on which characteristics that we distinguish the money market and the capital market? The difference is in money market and capital market is based on what?
Original maturity of the security.
Original maturity. So if the original maturity is less than 1 year, we classify it as a money market product. If the original maturity is more than 1 year, we classify it as a capital market product. So that's the basic or the simple way of classifying money market and capital market. So why do we need a money market? We have a separate session on money market. We'll discuss more detail in that. But here I'll give a brief introduction before it will help you to understand other concepts as well. So money market, basically it's a short term, less than 1 year maturity, used to finance your or whatever the organization short term funding requirement as a borrower, as a lender, to fulfill the short term investment opportunity. An institution or a bank or individual or maybe corporate may have excess funds, but for a shorter period. They don't want to keep it idle. They want to make an investment. So the money market is the best place. Likewise, from the borrower's side, there can be a cash flow mismatch or short-term funding requirement due to whatever the reason. So then they can go to the market and borrow for a short period, maybe for a 1 day or maybe 3 months, 6 months or 9 months. So for that purpose, this money market is used. So again, like in any financial market, that means bring together borrowers and lenders. This is the key. Maturity is less than 1 year. This is the one we use to distinguish between money market and capital market. When it comes to the capital market, it's not like short money market. The funding or the investment is for a longer period, more than 1 year, through which you raise capital, long-term capital. In money market, what you raise, we don't call it as capital, you may call it as working capital. But in the capital market, it's the long-term capital. The borrower needs not to pay it within a short period, or there's no requirement to pay it at all. We'll discuss that when it comes to the other products or the other classifications of the market, where the borrower has an obligation to pay or there's no obligation to pay back. So again, meet borrowers and lenders in the capital market. But here, both parties, a requirement of both parties are long term. Borrower need funds for a longer period. Similarly, investor or the lender wants to lend or make an investment for a longer period. So they do transactions through the capital market. So in the capital market, the maturity may be more than 1 year if there's any maturity, or there may be products where there's no specific maturity given. So that's how we differentiate money market and capital market. Then based on the product, type of the products that we, or based on the nature of the product, we divide capital market financial markets into debt market and share market. What is a debt? What is a share? What's the difference? That's the key here. What is the difference between a debt and a share? Can someone explain? Do you have any idea? What's the difference between debt and a share or equity?
Debt is just a loan, but when equity, we can have ownership of the company.
Yes. What do you mean by debt is a loan? On the share side, yes, that's correct. Perfect. If you use the same concept into the debt market or the debt or the loan, what do you have there? So in the share market, as he quite correctly said, if you buy a share, what do you get? You have a share of ownership of that company. You are an owner. Based on the number of shares that you have, the ownership depends. But you may have, if it is common shares, you will have a voting powers. You can vote, or you can make an influence on the decision. How effective that depends on the number of shares that you have. If you have only 1%, 2% of the shares, you have a very minority holdings. But if you can have a 50% or 60% of shares, then you can influence the decision. However, you can participate, and the profit will be shared. You will get your profit. So if the business goes bankrupt, you will lose everything what you make the investor. So that is a share. You get the ownership of a company, not the full ownership, but depending on the number of shares that you have. But in a debt market, or if you are a lender to a company, what do you get? You have a claim against that company. The company should pay you that back based on the terms and conditions agreed. If the firm agrees to pay after 5 years, the full amount, whatever the date on the maturity date, the firm should pay it back. But you don't have any control over the company. What is the business the company is doing? What are the decisions they are going to do? Where are they going to make new investments, expand the business? You don't have any control over those decisions. And as a lender, you don't, irrespective of whether the firm makes a profit or loss, the firm has the obligation to pay you back. But as a shareholder, you get anything only if there's a profit. So that's the key difference. In the share market, investors get the ownership. In the debt market, lenders or the investors have a claim against the firm. So in the debt market or the loans, firm has an obligation towards the investors. But in the share market, there's no obligation towards the investors, but the investors themselves own the company. That's the difference. So if you take some debt instruments, these are issued by governments or corporates. In most of the countries, government are the largest borrower. So there can be a specific maturity for a debt instrument. Common examples are treasury bills. Remember treasury bills. What are the maturities? Treasury bill maturities. Do you know what is the treasury bill and treasury bond? What's a treasury bill?
Bill is short term, bond is long term. That's what I can remember.
Yes, bills short term. That means treasury bills are money market instrument, bonds in the capital market, more than 1 year. Who issued treasury bills and treasury bonds? Who is the borrower?
Government.
Government. Government is the borrower. So when government wants to borrow for a short period, the government issues treasury bills. When the government wants to borrow for a longer period, more than 1 year period, government issues treasury bonds. There's a specific maturity. Debentures, again like treasury bonds, issued by corporates. Commercial papers, similar to treasury bills, but issued by corporates. Debenture is a long-term one. Commercial papers are short-term. So these are some of the products in the debt market. In the share market, common shares or common equity, that's the most common way. A company sells the ownership of the company to the general public. Then the general public can buy those shares, pay in the price, then whatever the collection would be the capital for the equity capital. Preferred shares, preferential shares, that can be converted. Sorry, there are some shares, or it's a mix of debt and share. Initially, it's a debt. You can convertible to the shares. That type of instruments also there. So those are the difference between debt market and share market. These are only few examples in the debt market and share market. Any question or any comment? Please feel free to ask any question. These are very basic, so I'm trying to cover it quickly. Then the next one is whether you create a new asset or not, or whether you trade existing asset. That's based on that we divide financial market into primary market and the secondary market. As I mentioned earlier, in the primary market, new assets are created. When a government issue a new bond, it's in the primary market. Or government issue a new treasury bill, it's in the primary market. If a firm, corporate, privately owned corporate, they want to sell their shares in the to the public, then it is they are coming to the market for the first time to issue shares. Then it is a primary market transaction. What does it mean, IPO? Initial public offering, where a firm or a corporate issue shares to the public for the first time in its history. That is we call initial public offering. So that's the most common mechanism to issue shares for the first time. Auctions is the most common method used by governments to issue treasury bonds or treasury bills. But when it comes to corporates, it may not be an auction. It may be when a corporate wants to issue debts, there may be an auction, or there may be negotiated sales or private placements. In this course, we are not going to discuss that much on the equity side, maybe very brief introduction on the equity markets and equity or shares, but we'll mostly focus on the debt instruments and other financial instruments. So therefore, we may not discuss in deep negotiated sales, private placements, but definitely auctions. We are going to discuss auction mechanism when it comes to fixed income securities. So we'll discuss this in the future. So that's the primary market where we create new assets. Second, okay, in the primary market, the transaction is between two parties. Who are the two parties? It is directly between borrower and the investor. Borrower pays whatever the amount to the, investor pays whatever the amount to the borrower. In the primary market, when you buy shares from the primary market for the first time issue through a first IPO, as an investor, you pay the cash flow and it will be collected or ultimately received by the issuing firm. But in the secondary market, it would be in between two investors. Nothing to do with the original borrower. This is in between two investors. One is buyer, other one is the seller. So no cash flow goes into the firm or the ultimate borrower. This is the market, secondary market. But the transactions are taken place among investors. The original issuer is not in the picture. They don't get anything. Original issuers, they won't get anything. This is purely among investors. Is it clear? In the primary market, it is used by the borrowers to raise capital or funds. But in the secondary market, existing asset, maybe a share, maybe a bond, maybe a bill, debenture, or a commercial paper, whatever tradable, they exchange among themselves. There are buyers and sellers. So no cash flow or no impact, can't say impact, no cash flow goes to the original borrower. So that's the key difference between primary market and secondary market. As we discussed earlier, when we have a financial market, we have some advantage. Price discovery. We know what is the price of a particular asset, or we can at least have some estimate and provide liquidity. An investor who purchased or hold into a security or a equity, if there's a sudden liquidity requirement, that investor can go to the secondary market and dispose his investment. That means sell that investment to another person and generate funds. So therefore, secondary market helps to provide liquidity to the investors. But in the primary market, it will help to generate liquidity to the borrowers. And in the secondary market, it will create the market efficiency because a lot of players are there, a lot of information available. Then resource allocation would be taken place in an efficient manner. So key here is how do we distinguish primary market and the secondary market. Then whether it's based on the delivery, cash market or the spot market and derivative market. In a cash or spot market, when you buy or sell something, the buyer will pay cash immediately and the seller will deliver you the asset that you trade. But this immediate, there's a difference. What does it mean by immediate? It's not like a customer comes to you. This is very important. Pay your attention and understand this part. We'll discuss this later as well, but I want to highlight it here as well. Immediate delivery. This one is not like our day-to-day transactions, what we carry on. If you go to a shop, you pay cash, you get your goods immediately. But in the financial market, wholesale market, it's not the case. You come to an agreement on a particular day, but you exchange your liabilities on another date. It won't happen on the very first day. It may be or may not be. That's why it says delivery T plus equals 0. So what does it mean? You come to an agreement today, you exchange the cash and the security today itself, security or whatever the asset. But T equals 1, that means you come to the agreement today, but you transfer the ownership on the next business day. T equals 2 means you transfer ownership after 2 working days or 2 business days from the very first day that you come to the agreement. Or it can be T equals 3. That means after 3 days. So therefore, but here we call it immediate delivery. For different products in different countries or different markets, this immediate delivery varies. But it's a standard practice in that market. For a particular market, there's a standard way of doing that. Based on that, we call it immediate delivery. But the key is on this delivery date, you exchange the product and the cash flow or exchange your obligations. And with that, the total value will be transferred between 2 parties, buyers and the seller. But when it comes to the derivative market, it's not the case always. There can be total value transfers or there may not be. So that's why it says may not transfer the total value, or maybe no delivery at all. That means you don't deliver what you agree to say. You don't give it to the other party, the buyer. Buyer may not get anything. The key is if there's any delivery or any exchange of funds will take place on a future date. But now you may argue, even here, T equals 1, T equals 2, T equals 3 is our future dates. Then what is this future date? That is beyond these days. If you settle this, if you deliver these after the immediate delivery date, then it will become a future date in financial market. It's not the future that we hold in our day-to-day life. This has relevance or reference to the standard settlement dates or what are the immediate delivery dates. We'll discuss this in a bit, little bit details. The key is here, even in cash or spot market, the date that you come to the agreement is, we call it trade date. It is different from the date that you exchange or transfer the ownership. It will be after few days from the trade date. We call it value date or the settlement date. But in derivatives, the settlement date, or if there's any delivery date would fall after the standard settlement date. And the other key is in the derivative markets, price of this derivative is derived based on the based on an asset traded in the cash market. It can be a bond, it can be foreign exchange, it can be shares, or it can be any agricultural product. Whatever the instruments that we discuss in the last during the last week session, we discussed few asset classes, assets. So whatever asset, based on the prices available in the cash market, value of the derivative product will be decided. So we call this asset as the underlying asset. Based on price of one asset, price or the value of the derivative product is decided. It is derived from something else. That's why we call it as a derivative market. There's a module on derivatives. We'll discuss more details in the derivative module. And don't think this is too hard derivative. It's not. If you know the basics in the cash market and the spot market for these products, then it is easy to understand the derivative market. So again, don't give up. The first thing is you need to get the basics correctly. What are the characteristics of the instruments that we are going to discuss? Then based on that, you can learn on the derivative products as well. It is not difficult as some of you may think. Only thing is you need the basics. So then based on the organization of the market, over-the-counter market and the exchange-traded market. So if I start with the exchange-traded markets, that is a market place where you can trade financial products in a well-organized market. It is a well-organized market. There are a set of rules, regulations, and the standardized products is the key. In the organized market, the product is standardized. That means even the maturity is decided by the entity we call the exchange. Because this market is regulated by the exchange decides the, other than the price, the exchange decides the most of other terms and conditions of an agreement or a contract for the product. So the products traded in the exchange are very standardized product and very well regulated. Even the settlement takes place through that exchange. So therefore, there's almost no settlement risk or the credit risk in the exchange traded market. But over the counter market is different. There can be regulations, but generally applicable to the market participants. But the terms and conditions can be decided by the parties involved in the transaction. In the exchange traded product, mostly the price and the quantity, again the quantity with some restriction, can be decided by the buyer and the seller. But in over the counter market, anything, price, quantity, maturity date, everything can be decided by the two parties to the agreement. So it is just an agreement between, or the transaction between two parties. No one else knows that there was a such a transaction. So it's less organized. So therefore, you take the risk of the other party in the over-the-counter transaction in the wholesale market. But in the exchange traded product, the counterparty risk for the settlement risk is very low. Just then the depending on the size, what is the volume of a transaction, depending on that we name this as retail market and the wholesale market. Again, depending on the country and the size of the particular market, minimum amounts in the large or the wholesale market would be decided. There's no hard and fast rule or to say you need at least 10 million or 1 million to be in the wholesale market. There's no hard and fast rule. That depends on the product, country, whether it's in the wholesale market or the retail market. But as you know, whenever you say retail, that is small quantities. You trade small volumes and basically cater for individuals or maybe for small business. But in the wholesale market, the size of the transaction is high and mostly participated by large institutions. So the same product can be traded in the retail market and the wholesale market. There's no difference. But the margins you charge, commissions you charge, things like that may change in the retail market and the wholesale market. So that's the introduction to the different segments of the various segments of the financial markets. To summarize, so we have capital market. What is the use? We transfer funds from the lender to the borrower. Borrower get funds for a longer period. But in the money market, what do we transfer? Transfer the liquidity, ability to pay. So in the money market, it's a very short term. Therefore, we transfer liquidity. Borrower receives the liquidity while the investor or the lender forgone his liquidity. In the currency market, that facilitate international trade. Why do we need currency market? Foreign exchange market, the origin is to facilitate international trade. Again, when it comes to foreign exchange market, we'll discuss this in detail. We use derivative markets basically to transfer risk, but remember, that's not the only way that we can use derivative markets. Even in the currency market, though the basic requirements came from international trade, currency market is used to not only to settle your international transaction or facilitate your international trade. Same thing in the derivative markets as well. Though that's the basic or the fundamental usage, transfer the risk, but you can do it for speculative purposes to make money out of it. Then the commodity markets facilitate trading of commodities. And again, when we say commodity market, it can be purely you trade commodities like oil, gas, rice, sugar, things like that, or it can be a derivative product based on commodities. Yeah, indeed, the derivatives you use to transfer risk, the derivatives can be based on any of these or products available in any of these markets. The derivative can be derived based on the capital market product, a debt, or maybe shares, or maybe interest rates. Money market also same. Or derivative, there can be a derivative product based on the exchange rate. So, but the usage is basic usage is to transfer the risk. Any question? Any questions? So any comment? Am I too fast or too slow? If you have any concerns, please let me know. No, not at the end of the course. It will be too late. Then again, this is a different view of looking at the financial markets, maybe based on again usage. It can be for funding or investment purposes, where investors and borrowers exchange the funds mostly in the capital market. It can be through bonds or equity that serves the funding requirement and the investment purposes. On the other hand, the other market is the transactional market that facilitates the transactions to carry out immediate business. Foreign exchange market, as I mentioned earlier, currency market is to facilitate the international trade. You need to buy foreign currency or sell foreign currency against the local currency because you want to import something from a foreign country, or you have export proceeds. Now you want to spend that money locally to pay your wages and buy raw materials. So you need the forex market. That's a transactional requirement. Trade finance. You need to ship something until you get the export proceeds. You need to fund that requirement for a short period. That again facilitate a transaction. So it can be commodity transaction, exchange commodities. You want to buy raw materials, commodity raw materials. Say you want to buy copper. Financial market facilitates that requirement. It's a transaction. Then through derivatives or maybe some other products, we do risk management. Basically through derivatives, and insurance plays a major role as well in risk management, through which the participants or maybe the investors or maybe firms hedge their exposures, minimize or mitigate their risks. If something goes wrong, to minimize the loss that can happen. That can be done through derivatives or insurance, that risk management. So likewise, there can be, if you take a book and read it, there can be a separate classification in that book. But basically, whatever the word or the classification is used there, the functionalities or the characteristics are the same what we discussed, or there can be overlapping. So here, if you take funding, this is like capital market. Transactional, this is mostly like money market. Risk management, mostly derivative market. Likewise. So, but you look at the same product in different angles, you can classify it in different way. So to do that, what you need to understand the basics of these products. What are the available products in the market? What are the money market products? What are the capital market products? What are the characteristics? How do we price those things? What are the risk of those instruments as an investor, as a borrower? Then how do you mitigate that? That's the thing we are going to cover next maybe 1.5 months. Then we'll switch to Treasury side. What are the basic functions of Treasury? Then again we'll come to derivatives and risk management. That would be the flow in the future. So who are the next thing is, who are the participants in the financial markets? That is also important to understand. You should know who are the major participants and why do they participate in the financial market. Based on that, you come to know the impacts. When you see some participant is active in the market, you can have some idea what would happen to the in that particular market, because different participants plays different roles, their requirements are different. The major participants, the top is the government. Why? As I mentioned earlier, many countries, governments are the major borrowers or the largest borrower in that country, that particular market. Most of the countries, that's the case. So therefore, government borrowings. What is the size of government borrowings? That matters. That will have an impact on interest rate. Availability of funds to grant loans to other private sector institutions. So therefore, government plays a major role. Not only that, government can impose regulations or introduce different tax that will have an impact on financial markets. Issue different regulations in different for different segments of the economy, control them. So not only direct participation, there can be indirect participation as well. So you have to pay attention. What are the government actions? What are the new regulations or tax policies? What is government budget? Whether the government is going to give salary hikes to the government servants, whether government entities making profit or loss. These things are very important too, because all those things ultimately have an impact on the financial market of that particular country. Then central banks. Central banks plays a major role in financial markets because central bank has the power to print money, control the money circulation in the economy. By increasing the money circulation in the economy, central bank can lower the interest rates. For decreasing money supply, central bank can influence the interest rates to go up. Not only that, that's as the money supplier, and with one of the objectives, price stability. Central bank can influence the interest rate and money supply, and through that, the economic activities. That will have an impact on all other sectors in the economy and the financial markets, because economy and financial markets are like two sides of the same coin. They go together. Not only that, central banks can regulate some of the entities in the market. Therefore, the central bank can issue regulations. We have a separate topic here. They are as regulators, but I'll discuss it here as well. Central bank can issue directions to banks, other financial institutions that will have an impact on the economic activity. Foreign exchange market, central bank can intervene in the foreign exchange market either to buy or sell foreign currencies to maintain the volatility of the exchange rate. Issue directions on that. But not all those things are done by each and every central bank. Depending on their mandate, there can be slight differences of their roles, but those are very common for all the central banks. Then other financial institutions. When I say financial institutions, it covers whatever the banks, whether it's a commercial bank, specialized bank, investment bank, all those things. They play a major role because, as we discussed, banks collect funds from depositors and lend out to borrowers. They trade among themselves. Whenever one banking is in a shortage of funds, that bank borrows funds from other banks. They invest in government securities, corporate debentures, or buy shares. facilitate economic activities in the market. Finance and leasing companies, they do the same thing. Primary dealers, they are mostly trade government bonds. They are the ones who can submit bids in the primary auction and buy bonds and distribute among other investors, those who want to buy government bonds or treasury bills. Then insurance companies, for the risk management perspective, we buy insurance. Then they collect premium. They have a large pool of premiums. The amounts are very high. They don't keep it idle. They make investment. So they come to the market as an investor, insurance company, rather than a borrower. Very, very rarely they borrow to meet their short-term liquidity shortage, if there's any. But very rarely they do that. But mainly the insurance companies are investors. They have excess funds. They make investments in basically in government securities, corporate debentures, maybe shares. So that's a very good funding source available in economy. Then pension funds and other endowments. What are the pension funds in Sri Lanka? What are the pension funds? What are the pension funds available in Sri Lanka?
EPF,
EPF, is that all?
ETF,
ETF, these are the larger pension funds, especially EPF. But this is sort of government. But there are private pension funds as well. Now there's a rule because the regulation, private corporates, they cannot maintain their own pension funds. But there are few exceptions. There are firms, they maintain or they manage their own pension funds or the PF, provident funds. So there are private companies, few companies, they maintain their pension funds as well. But in Sri Lanka, this is the situation. But if you go to other developed countries, within a country there can be many pension funds. Some are maybe like our EPF, ETF. There's a government involvement. Some of them are just the firms managed by themselves, and others are like investment houses. They create, but individuals can participate or contribute to that pension fund and get the pension on retirement. They fund the as an individual, contribute to the pension fund and get the benefit at the end. That sort of pension funds also, private pension funds also available in other countries. Endowments, what are those? What are the endowments? These are like trust funds. Is there any trust fund in Sri Lanka?
So MSPS falling under which category?
Sorry, I didn't hear that question.
MSPS like mercantile fund, something falling under, is it like a private pension fund?
Mercantile.
We have like, I can't remember the full name, we call it MSPS. It's like EPF. There are some companies who maintain their EPF fund.
Their own PF funds, yes.
Yes.
Those comes under pension funds, as I mentioned in Sri Lanka. I think before the establishment of EPF fund or something, with some exception, only few corporates are allowed to maintain their own provident funds. They maintain their own provident funds, but others, they are not allowed to do that. They have to contribute to the EPF.
Okay.
This one may be that sort of private pension fund, or we call them superannuation funds. It's not say provident fund and the pension is two different things. In a provident fund, when you retire, you get the lump sum. In a pension fund, you get a monthly payment like salary. So that difference is there. So generally we call them as superannuation funds, even though I put it as pension funds. What are the endowments? Is there any endowments in Sri Lanka? We may not use this word in Sri Lanka. But we may use this trust fund or trust. Any idea about this in Sri Lanka? There are a few, and they are quite large. Whatever the name they call it, they are endowments. Say it can be a religious place, or maybe a temple or a mosque or a church. They get a lot of funds. They do investments. They don't keep it in their tails. So there are few in Sri Lanka, and very big. And the other thing is, there can be schools. They manage through a fund. They don't take government. They don't use government funds. They may have investment funds. Especially in developed countries, they have universities. They have endowment funds. They manage or they grant scholarships to students through those funds. On the other hand, they charge students. From some students, they charge. They add that funds to the endowment funds, and basically this is the funding source for the university. Even the salaries are paid through these endowments. These are very big. In other countries, there are things like that. So therefore, ultimately, pension funds or the superannuation funds and endowment mostly are investors rather than borrowers. They are mostly investors. Depending on their investment strategy, they may borrow short term, but they are not supposed to generally, because they have cash flow. What they want to do invest excess cash and generate enough funds to fund the future requirement. That's pension funds and endowments. Then hedge funds. I don't think Sri Lanka we have hedge funds. Again, they have different strategies of managing funds. It's an investment, and they take some high risk and with the expectation of achieving high return, hedge funds. Then the last category, individuals. Individuals may be high net worth individuals or maybe retail. They make investments or they borrow. They participate in the financial market. So, what is the role of financial institutions? These financial institutions, if we take, as we discussed last week, to minimize the cost, to reduce the cost of a transaction and improve the efficiency in the market. Borrowers should be able to borrow at a cheaper cost, and the investors should be able to invest to a good place or make a good investments without incurring a large cost. When I say cost, it's not the interest rate that you pay or receive or whatever the return on the investments, the other cost that you incur. I mentioned that in last week as well. Say, before you make an investment, you need to do a lot of assessments. For that, you need information. That cost of screening should be minimal. Borrower may not reveal everything, but there should be a way to get most of the things out of the borrower and have a proper assessment on the borrower before you make a loan or grant funds or lend funds to the borrower. So as an individual, it is very difficult for us to do that. But through financial institutions, that can be done. Financial institutions, since they lend in large volumes, they can get most of the information from the borrower, get to know more the things from the borrower and make a good assessment and price the product properly. So then the resource allocation, fund allocation would happen in an efficient way. So through that, savers will get a savers, or the investors will get a access to the market. Not only that, again, they will get their funds back. So that is basically on the financial markets and participants. We are going to move into instruments. What are the instruments in financial markets in different segments? But some of the products we may discuss bit detail here, but some of the products we'll keep it for further discussions at a later stage. Before we move into this, if you have any questions, please ask. If you have any questions, please ask. If you don't have any questions, I'll move forward. We'll discuss financial instruments in different markets briefly. Money market. What is the money market? What is the money market?
Short term.
Yeah. Where we trade instruments with maturities less than 1 year. So you can see a list money market instruments. The first thing is cash. What are the differences? When you have cash, you can use it immediately without taking any time to pay your obligation. You can go to a boutique and buy something, or you have to pay somebody, you can pay. So cash is easily transferable. What are the risks? Or what are the downside of holding cash? Will you get any return on cash? Do you get any interest income on your cash, what you are holding?
No, sir, no.
No. If you have 5,000 rupees in your wallet, you won't get. But anytime you can make a payment. What other risks are? Is there any risk of holding cash?
Yes, sir. Theft.
Yes. Yes. If somebody takes it, there's no way to prove that it is your money. The moment it goes to someone else's hands, the ownership is transferred. There's no record. There's no way to prove that it is yours. So loss or theft, that is the risk. So that's why these things that you should know about these products. What are the advantages? What are the characteristics of having those? What are the opportunities that you may forego or you may get? Income and risk. Those are the things. So cash is the most liquid form of assets. You can use it anytime and the ownership is transferred to the other party and nobody cannot say, I cannot accept this. Cash. No one can reject to accept cash. Current accounts and savings accounts. Again, even though I have put it into money market savings, yes, because theoretically, current accounts also, it's on demand. Whenever they ask, the investor or the depositor asks, you should be able to pay it back. Current account, there's a what is the difference, major difference between current and saving account? What is the main difference between current and savings account?
There's no interest for current accounts.
Okay. What else?
Anyone can be open that with minimum
Sorry, anyone can?
open a saving account with a minimum.
Current account?
Use of checks. Check transactions.
Sorry, I didn't hear that.
Use of checks.
Money creation.
Money creation. In which one?
Current account.
Current account. Is it the main difference between current and savings account?
There's a credit limit in current account.
There's a credit limit.
Credit limit.
Yes, that is there. That means the account holder can withdraw money more than in its account up to that limit. That's true. But what's the key? Now that is with the development of technology and things, we don't use that. Oh, still we use that, but it becomes less popular. The check writing ability, isn't it? That's the key. In the current account, you can do you issue checkbooks for savings account? No, that's only for the current accounts. Through that only they can that will generate money creation, as someone mentioned, overdraft or the credit limit is required. All those things comes with that. But nowadays with electronic fund transfer available even through savings, now we do the almost the same thing. Only thing, in the saving account you cannot overdraw. You have to maintain the minimum balance. But in current account it is not. However, what else there? Current account you don't get interest. Savings account you get some interest. And but liquidity wise, both accounts you can take out your money. From the same risk side, is it safe? Maintain current and savings account. Yes. What you take the risk of the bank. No one else can get your money out unless there's a technological risk. If someone hacks the system or steal your debit card or something like that. Call accounts, it is against sort of savings account, but you will get slightly high interest income. It's kind of a fixed deposit, but again kind of a savings. There's no specific maturity given, so therefore you will get an interest in between savings and fixed deposit. But if you want to withdraw funds, you may have to inform the bank in advance, maybe 1 day or 2 days in advance. I want to get that money back again. But again, that call accounts are mainly operated in the wholesale market, not in the retail market. Then the very common product that we know, fixed deposits or the term deposits. Again, that can, so that means, what does it mean by fixed deposit? There's a specific maturity period. Investor can get that money back only on the maturity date. If the investor withdraw it before the maturity date, the investor won't get the stated interest. It may be at a lower interest or maybe no interest. The fixed deposits and the term deposit both are same. What does it mean? There's a stated maturity period. Then treasury bills, as we mentioned, issued by government to borrow funds for a short period. What are the maturities available in Sri Lanka for treasury bills?
91 days, 182 days, and 364 days.
Sorry?
91 days, 182 days, and 364 days.
91,
182 and 364.
2 and 360.
4.
182 and 360
364
days. So these are the original maturities. The government issues treasury bills with maturity of 91 days, 182 days or 364 days. So issued by the government. What are the commercial papers? Commercial papers like treasury bills, but issued by corporates. Again, but maturity dates, there's no rule like this for commercial papers. Commercial paper maturity date that depends on the requirement of the issuer or the corporate. Certificate of deposits. I don't think in Sri Lanka we have this. Certificate of deposit, again, kind of a fixed term deposit, but this is the key is this is tradable. What does it mean? What does it mean? Tradable. What do you mean by tradable asset? What do you mean by tradable? Can treasury bills or are treasury bills and commercial papers tradable? What does it mean by tradable? Any idea?
Anytime you can convert it to cash, you can resell in the secondary market.
Yes, tradable means you can trade it in the secondary market. The holder or the holder of the asset can transfer the ownership to some other party and receive the proceedings or whatever the agreed amount. That is tradable. That means you can transact it in the secondary market. Treasury bills, you buy it after a few days. If you think you don't want to hold that treasury bill or you need cash, you can sell it to another party and get cash. But remember, the amount that you receive, it may or may not be the amount that you invested or the amount that the issuer agrees to pay on the maturity date, it may or may not be the case. That depends on the product, market instrument, and product market condition. Based on the product and the market condition and features of the product, that depends whether you receive your initial investment more than that or less than that, or the maturity amount. However, these treasury bills, commercial papers, certificate of deposits, again, there are two types, tradable and non-tradable. When it comes to non-tradable, it's almost like a fixed term deposit. Generally, they are tradable. When it we'll have a separate session on money market. In that, we'll discuss this in detail, how a certificate of deposit works, and treasury bills, how do we price it, what are the other terms and conditions in treasury bills, and commercial papers. The other money market product, very important one, is the repurchase and reverse repurchase agreement. Repo means repurchase agreement. We call it in short repo transaction. And a reverse repo transaction, again, don't worry, this repo and reverse repo is the same transaction. It's like lend. If you lend, you are a lender. What is the transaction to the other party?
Borrowing. Borrower.
The other side is the
Borrower. Borrowing side.
Borrowing side. One side is lending, other side is borrowing. The repo and reverse repo is also the same. One side is doing a repurchase agreement or transaction, other side is we call doing the reverse repo or the reverse repurchase transaction. Buying and selling. When one party buys, the other party sells. So this is the same transaction, but in two different angles. So we'll discuss this also in detail when it comes to money market instruments. These are the money market products commonly available in many markets. There can be slight deviations or and new products with slight deviations of these, but these are the very common. But in the wholesale market, mostly treasury bills, reverse repo, and when it comes to banking, there's another one called cold money market. We'll discuss this as well. This is very important for banks to maintain their liquidity. Here, basically, what happens? Banks lend and borrow from and among each other, between themselves. One bank borrows from another bank. That is we call cold money market, mostly for with maturities, overnight maturities for a 1 day period. There can be slightly longer maturity up to maybe 7 days. This is called money market. This is also a money market product in financial markets in many countries. So with all those things, we'll discuss money market in more detail. But again, money market products applicable in the wholesale market, in a coming session where we are going to discuss money market products, their characteristics, why do we use money market, how do you price these treasury, how do you price treasury bills, how do you price repo transactions, reverse repo transactions, how do you decide cash flows, cash amounts. These things we'll discuss later. So then in the capital market, as you remember, we can divide it into debt market and the equity market. Capital market is the long-term funding market. The capital market, treasury bonds issued by governments, then corporate bonds for the and debentures issued by. There's not that much difference in corporate bonds and debentures. Just two terms used in different markets. Different terms are used. In Sri Lanka, we mostly call them as debentures. It's a bond issued by a corporate. Then in treasury bonds, generally the interest payment is a fixed amount. Even the corporate bonds, interest payment is a fixed amount, fixed rate. But there can be bonds where the interest component or the interest rate changes with the time. We call them floating rate notes. We'll discuss this when we discuss fixed income securities. Then convertible bonds, as I mentioned in the shares. Convertible bonds, after some time, if issuer wishes to do that, can be converted into shares of the particular firm. Index-linked bonds, again, it's a debt instrument, a bond, but the cash flow payments are linked to a index like a CPI or maybe index that you can understand, whole share price index, something like that. There can be many different type of indices. The payment of the bond can be linked to one of these indices, but nowadays, even in the global markets, these are not that much available. Then asset-backed securities. Again, this is a special type of bonds or the fixed income security asset class where you get the cash flow based on a set of assets and the cash flow generated through that asset. Those assets can be set of loans, maybe credit card collections, mortgages, or things like that. So again, when it comes to mortgage-backed securities, it's a subclass of asset-backed securities, because same thing in the mortgage-backed securities, the bond is paid through a cash flow generated by the set of mortgage loans. In the asset-backed security, when you say asset, the asset can be anything, but at the time of issuance, issuer says, okay, these are the assets. These are the set of mortgage loans that we are going to use to fund this security. So these are just introduction. Now itself, you can try to read and find out things on these different asset classes or the different financial instruments. That will help you to understand more when it comes to that topic and when we discuss these things. Definitely, we are going to discuss most of the things: floating rate notes, asset-backed securities, mortgage-backed securities in future. Then the capital market other asset class is equity, where you get a ownership of the firm. Then common stocks, preferred stocks, and warrants. Common stocks you have a, that's the common, that's the plain vanilla product. You buy a share, then you have the voting rights. They will call you for AGM or special general meetings whenever there's a specific event to happen or specific action to be taken by the board. So you appoint the board, then you give powers to the board to take decisions. And there can be some instances the board cannot take decision. Board has to go back to the shareholders and get their consent, whether to go forward with that intended action or not. So when you are a holder of a common stock, you have that voting rights. If they pay dividends, you will receive dividends. In a preferred stock, you get some priority over common shareholders when they pay dividends. There may be a stated dividends, that means like a coupon in a bond, you get a fixed dividend. Or that dividend may be deferred. But if there's any preferred stocks, before they pay, the company pay any dividends to the common stock, they have to pay it to the preferred stock holders. So then the warrants, and there can be equity options and things like that. However, we are not going to discuss equity market here. Then the currency market, where we trade foreign exchange, buy and sell foreign currency against local currency. Oh, now we can say foreign currency against local currency. When we think locally, domestically, we are in Sri Lanka, our currency is rupee and all others are foreign currencies. But in general, foreign exchange market means exchanging two currencies. So you can sell dollars and buy euros. Both are foreign currencies for you. So there may be requirements to do that when you are interested. So even though the term call it foreign exchange market, or sometimes we call it currency market, whatever it is, but it says buy and sell currencies. So exchange one currency against another currency, and this spot term cash forward, these are related to the settlement date that I mentioned earlier. When you come to the agreement and when do you make the settlement, that is the difference. Spot market, term market, cash or forward. So I'm not going to discuss it here. We'll discuss that when it comes to foreign exchange market. I just wanted to give a brief introduction here. Currency market, where you buy and sell currencies, buy one currency against another currency. Then the derivative markets, again, just a list of some derivative products. I'm not going to explain these products here now because we will discuss all those things in detail in the derivative module. Forwards, futures, more or less the same. The difference is one is OTC, over the counter market, you may remember. The other one is exchange traded one. Forward rate agreements based on the interest rates, how do you fix an interest rate for a future transaction? Not borrowing today or lending today, but if you want to borrow, lend in 3 months time, you want to fix the interest rate, you can use this forward rate agreement. Shops, you exchange. Oh, this is a very common famous word these days. So you exchange one currency against another currency, or however here, what do? We exchange two different cash flows. We'll discuss all those things in the derivative sections. Options, as it implies by the name, the buyer has a option to do whatever, not whatever, based on the agreement, the thing, few things that he can do. All these things are based on the financial assets or financial variables in the financial markets, or maybe commodity. But when it comes to credit derivatives, this is depend on the credit quality of a borrower. To manage the credit risk, we use these credit derivatives. So we'll discuss these things in the derivative. These things about the market risk, that means price of underlying assets, but this is about the credit risk of a particular issue. Based on that, we derive another product. Then the regulators, in any country, there are regulators to the financial market. Central bank is at the top in the most countries, but in some countries, central bank does not do regulations on the financial institutions, but some financial markets. Then the Securities Exchange Commissions in different countries, they set up policies and regulations on the securities. Whenever we say securities, generally it can be shares and bonds both, but in different countries, different regulators regulate bond market and share market. Then the insurance board is there to regulate insurance companies. In Sri Lanka, central bank regulates banks and
Primary dealers,
non-bank
financial
institutions. But in some other countries, central bank does not do that. Can be separate financial. Whatever the name, they have separate. In countries where so there can be commodity market, futures derivative product. So there can be lot of futures trading. Therefore, to regulate it, they have commodity futures trading companies. So likewise, there can be few other regulators depending on the market country. Any question?
Huh?
Then apart from that, participants and the regulators, there are another set of participants or service providers, we call it. They provide services required for the proper functioning of financial market. One is exchanges, like our Colombo Stock Exchange. It it provides a service. It brings the buyers and sellers together and provide the platform to trade equity. In other countries, not only equity, listed bonds, maybe issued by governments, maybe issued by corporates. They trade in that exchange. Then the brokers, even though large banks, they want to trade, they cannot find out a proper counterpart to enter into a transaction. Then they will use a broker to find out a buyer for a seller or seller for a buyer. So the brokers, but with the electronic platforms, availability of electronic platforms and developments, now around the world, brokers' role is diminishing. So unfortunately, maybe brokers, they may have to think about their business model and come up with different things. They will be eliminated from the system very quickly. Even in Sri Lanka, I think brokers' role maybe go or vanished in future with the technological developments. Then the credit rating agencies, they assess borrowers or the issuers, then they give a credit rating on that borrower. They have a procedure laid down, they follow that procedure and give the rating. The best rating is AAA. And the notations maybe varies from the rating agency to another rating agency. Fitch and S&P uses this notation. Moody's uses this notation, capital A and two simple A's. But Fitch and S&P, capital, all capital A's, AAA down to D, default. So triple B and above, we call them as investment grade firms. Triple B, below that, we call non-investment grade or junk. So based on the ratings, or rating will give the investors about the credit quality, ability to repay of the borrower. There are criticism on rating agencies, especially with the financial crisis. Even the AAA parties pay. True, even though the party is highly rated, there's still a chance to default, but very minimal chance. If you go to these rating agencies websites, you can see there's a matrix for each rating category. What is the probability of default within a 1 year period? What is the probability of moving from a AAA status to a AA plus status, or from a for any other rating category? Likewise. So that will give some view on the credit worthiness of the borrower to the investor. Credit rating agencies get their income through the issuer or the borrower. Whenever borrower wants to get a rating, they have to go to the rating agency and say, please rate me. Then the credit rating agency will go and do the analysis. They will do the historical analysis and mostly about the future, what would happen in the future. Then they will issue the rating. But they will charge from the issuer, the party who requires rating, then the investors can get that rating and use that rating for their investment decisions. Then the credit bureaus, again, this will give credit history of the borrowers, whether they have defaults or not, or when, why, these things. In many countries, there are credit bureaus. Then the other most important party is the information providers. Even a newspaper is an information provider about the market. So Bloomberg is one of the major participants or the service provider in the global market, Bloomberg, Reuters, or any other news channel, BBC, CNN, all those things. Maybe Economist magazine, Wall Street paper, things like that. All these parties provide information to the market. What's happening in a particular country or in a particular company, in foreign exchange market, bonds market, all those information are available in these platforms. Then the trading platforms. This is the one now replacing the brokers. There are trading platforms. That means you can log into a system and execute a transaction. That means you can buy or sell the asset that you want through the electronic platform. You don't want to call another party or contact a buyer or seller or contact a broker and say, okay, I want to buy this or I want to sell this. No, you don't want to do that anymore. Electronic platforms are there. What you have to do is get the service, log into that, and trade the transaction. Within few seconds, you can execute a transaction. So the world is moving towards that. Even in Sri Lanka, you may see a trading platform available in Sri Lanka maybe in 2 or 3 years, right? So again, Bloomberg, it's not only a information provider, it facilitates trading. It provides a trading platform. Reuters also the same, but now Reuters, they break into two. The information provider is separate and the trading platform is different, Definitely or something like that. So however, there are a lot of electronic trading platforms available in the global market. In some banks in Sri Lanka, they use Bloomberg and Reuters to do foreign exchange transactions and government bond transactions. But in Sri Lanka, the government bonds are traded through trading platform is very minimal, very low, but at least there are few transactions. So all these services are required to efficiently function the financial market. So that's all about the financial market that I wanted to discuss. If you have any questions, please raise. Any clarification you need in this?
Sir, you told us that Fitch and Moody's are using 2 different ratings.
Sorry, I cannot hear you properly. Can you speak loud?
Yeah, can you hear me now?
Yes.
Yeah, you told us that Fitch and Moody's are using different type of risk rating. Let's take AAA, which Fitch is using, and other one is capital A and two simple A. These that I mean same level of rating?
Yes, yes. It's just the notation that they use. Say it's like this. I will open. It's the same. Say AAA by Fitch and S&P, and this is the AAA equivalent for the Moody's. Then A plus different way in the Moody's. That's how it goes. But same number of categories they have. Is it clear? So
it means weightages are same, no?
Weightage. What do you mean by weightage?
Let's take AA plus and capital A and simple A.
Yes, that means all we can consider both at the same level of rating.
But the mechanism.
But the thing is, it's not easily the way S&P analyze a particular issue or the generally their mechanisms may be vary. So they have their rules. Basically, what they do, they calculate a probability of default. They calculate the probability of default. So they say if they want to assign a AAA, the probability of default should be at a particular range. I'm not sure whether Moody's and S&P and Fitch uses the same range. No, it may not be the case. So you have to go and check that whether there can be a whether there's any difference. But generally, when it says AAA like this or this, that's the best rating. Then the next, when it comes to next level, is the it is like Moody's use instead of plus, they use this 2-1 that numeric subscription and numeric figure, not a plus sign or the minus sign. But we can match them as a category. But there can be differences in their analysis. Anything else?
Thank you.
So will you be sharing the slides of the presentation with us?
It's, I think, already in the classroom. So you go to the classwork, you can see the presentation. This is the syllabus, this is the presentation, the introductory presentation, and this is the presentation on the financial markets, the one we discussed. This is the presentation that we are going to discuss. You can download it. So generally before the class, maybe Wednesday or Thursday, we upload this into the classroom. If you want, you can take a print out and get ready for that. As I mentioned, you won't get, say, notes. I won't read out anything for you to note down while I am explaining. What are the things you think it is required to note down? Please note down by yourself. And if you want me to pause, please ask me. I'll pause, or you need me to repeat that, you can do that. Anything else? So to access these things, you have to log into Google using your IBSL account. You might have got an email address, but whatever the first part, and then at ibsl.edu.lk. Use that username to log into the Google account and then go to Google Classroom. Then you have access to all those things. So please respond to this survey. So see, we can see where are you. So out of 18 responded, 12 were for banks, 3 in finance and leasing companies, 1 in insurance, 1 is in broker firm, another one in is corporate. I'm not sure where are the others. So that will help me to understand you and identify you and change or cater your requirement. So please respond to this and your level of knowledge, experience, educational qualifications. These things will help you. Sorry, there's a small mistake. This should be IABF, not CABF and the DABF. So please respond to that as well. And anything else? Any question? The other thing is, yes, you have the video, you can watch it at any time, but I prefer if you can join and participate in the classroom, then you can ask questions, you can answer my questions and see whether your understanding is correct. Just by watching the video, you may not get the full use of it. So any questions? If you don't have any questions, we'll take a break, about 15 minutes. Then I'll straight away start the next topic about calculation of time value of money, calculation of future value and present value. Some of you may already know how to do these things, but see whether you know that properly. We may discuss different scenarios. If you have questions, or you can ask the people, those who know these things, others, they can learn it. So we'll stop here, or that means we'll take a break here, about 15 minutes, and come back. Okay, thank you. So any questions? Any question on the topic that we discussed, or any other comment? So did you learn anything new? Or was it a refresher? You have to respond. Otherwise, I can't see your faces, whether you have understood or not. I don't know. So better you respond my questions to make it interactive. Otherwise, it won't serve the purpose at the end. So if you don't have any question, may I start this topic? May I start this?
Yes, sir.
Yes, sir.
Okay, thanks. So this is this involves some calculations. We have to work with numbers and formulas. I'll explain as much as simple. If you have any questions, please interrupt anytime and ask any questions. Don't worry. Don't worry about others, whether they have understood or not. If you don't understand it or you need any clarification, please interrupt me and ask any question, because this is sort of a foundation or the basic of what we are going to discuss in the future, especially with regard to all these financial instruments that we discuss. We are going to discuss these things in more detail about some of the financial instruments, say treasury bills, treasury bonds, then foreign exchange derivatives. All those things will be based on this. In the all these things, we will use the concepts that we are going to discuss here, and this is a key. So therefore, pay your attention. Make sure that you know all those things. Suddenly, maybe in 4 or 5 weeks time, we will refer to one of these equation or jargon. So you should be able to understand it without any doubt. So therefore, pay your attention. And workings, the calculations, do it by yourself. Another thing, calculator. For the exam, you are allowed to use calculators, but non-programmable calculators. So whatever the calculator that you are going to use at the exam, better take it now and be ready with the calculator and be familiar with the calculator, because different calculators work in different way. The keystrokes that you have to put may be different from one calculator to another. So don't use your mobile calculator today and bring another calculator on the exam date. You may not get the desired result, or maybe wrong results if you key it in a different way. And you can save time if you know how to key the numbers and the formulas into the calculator in a proper manner without, say, you want to do a small calculation, say 3 into 2 plus 5, something like that, without use the calculator, say 3 into 2, it's 6, write it 6 plus 5, then key the plus 5. Likewise, do small calculations and write the answer, and again key those answers and get the next level. And likewise, without doing that, you should be able to key the whole equation in a one go and get the answer finally. Then that can save your time, but you have to do it in a proper order. Otherwise you will get an incorrect result. So to do that, you should be familiar with the calculator in your hand, and which is that you are going to use it in the exam. So remember that when we discuss these things, I'll explain how to do these things in Excel. as well. Even though in the exam you cannot use Excel, but in day-to-day life, you will be able to use these functions in Excel. So other thing, please do these things by yourself without waiting for me to do all the calculation. First few things, yes, I'll explain how to do that. I'll demonstrate. Then I will post some questions as well. Do it by yourself. And if you have any questions, come up with those questions. Then we can discuss those things. By doing only, you can remember these equations and get to know the insight of these, what is behind these equations, the economics and the other concepts behind these concepts. With that, I'll move forward. It's about time value of money, so that relates to interest rate. So therefore, I will start with the interest rate. What is interest rate? What are the components of interest rates, or the different parts of interest rates? And how do you calculate simple interest, compound interest? What does it mean? Then for a single cash flow, what would be the future value? For a series of cash flows, what would be the future value? And the present value for both things, single cash flow and a series of cash flows. So that's the content that we are going to discuss. Probably we may not be able to finish everything today. So objectives, you may go through these and see whether you can do all those things at the end. So to start with the first question, or the first thing we have to understand is interest rate. What is the interest rate? What is interest rate? Any idea? So most of you are bankers. What is interest rate? You charge interest from customers, you pay interest for the customers. Even as individual, you may have loans, you pay interest. You may have savings account, at least you get interest on that. What is interest?
Return or the cost?
Sorry?
Return or the cost?
Return or the cost. Yes, we can see as a cost or a return, or the income. Okay. Yes, true. Return on what, or cost of what?
Return on investments and cost of borrowings.
Yes, we can say return on investment and cost of borrowing. True. Yes, because if you lend 1,000 rupees at 10%, after 1 year you get 1,000 plus something, 100 rupees. That is the interest. So that is the return that you earn. On the other hand, if you borrow, that you pay additional 10 rupees, that is the interest. That's the general understanding we have. But I would say interest rate is the cost of money or cost of funds. We can say it like this. So everything, there's a price. Interest rate is the price of money. Either you pay, either you receive it. So as we discussed, if someone borrows or someone lends, at the end, borrower will pay extra amount and the lender will get an extra amount. So that is that extra payment is the interest component, in interest amount. So we can consider it as the cost of borrowing, cost of funds. So that's one way we can explain. And the thing is, interest, we express it as a percentage of the amount, notional amount, or the amount that we borrow as a percentage. So therefore, interest we generally express as a percentage, and we call it interest rate. As you correctly said, we can think it in three different ways. It can be a required rate of return. You say you have 1 million rupees excess. You want to lend. What is the interest that you need? What is the return that you need? Is it 5%, 8%, 10%, or 20%, or 50%? That depends on the investment. Where are you going to make the investment? Is it in the government bond, or are you going to lend it to an individual who loans to you, or who is unknown to you? Or is it to a bank? Or are you going to buy a treasury bill or a treasury bond? Depending on that, your requirement, return requirement may vary. However, you express it as a percentage. That's the interest rate. So therefore, we can think interest rate as a required rate of return. If you think to buy a 3-month treasury bill and I need at least 10%, if you don't get that 10%, you may not buy that treasury bill. If you want to lend to a friend or someone known to you, depending on the relationship and things, you may charge interest or not. Or as a bank, if you want to lend to individual, you may need maybe 12-13% interest. If not, if the customer is not willing to pay that, then you may not lend that money to the customer. So it is as an investor, what is the rate that you require as a return? So we can think it as a required rate of return. Or on the other hand, we can consider it as a discount rate. So what does it mean? That relates to our concept future value and present value. Say there can be investment where in that it will promise you to give a cash flow in maybe 5 years time. Say there's an investment. Okay, you invest 100 rupees today. We will give you 500 rupees in 5 years time. Something like that. So then what is the discount rate? What is that value of that 500 rupees in 5 years time? What is the value of that 500 rupees today? How do you bring that future cash flow as at today and see what is the current value of it? For that, we use an interest rate that we call again the discount rate. So therefore, you can see it as interest rate as a discount rate. On the other hand, you can say it as an opportunity cost. If you don't invest somewhere, what do you forego? Oh, you have different alternatives to do that. You either invest in treasury bill or buy a land or just keep it in saving account. What is the cost that you forego? So that is also can be considered as an interest rate, that is opportunity cost. Because say, what do you do by investing money? What do you forego on today? By investing money, are you going to give up anything? By investing today, are you going to give up anything today? What do you think?
Yes.
Yes. What is that?
At Other opportunities available in the market?
Sorry?
Other investment opportunities in the market?
No, I mean, whatever the investment, you have investment opportunities. Wherever you're going to make an investment. By doing that investment, what do you give up?
Consumption?
Consumption.
You give up your consumption. So by investing, you give up your today consumption and postpone it. So there will be an opportunity cost of that. Because say something that you wanted to consumption today, without doing that, you postpone it 1 year. So there can be satisfaction if you consume that today, you don't get it just because of you didn't consume it, you postpone it. That becomes a part of that opportunity cost. Then by the time that you are going to consume that, the price of that might have changed. So that is also added. Likewise, interest rate we can consider as an opportunity cost. So therefore interest rate, most probably we can see it as a required rate of return or a discount rate or an opportunity cost. But if you want to know these things in a very deep manner, maybe these things you may consider this as economic concepts, so better you read in detail. But as you have understood properly, if you borrow, there's a cost of borrowing. That is the interest. If you invest, you get a return on that. That is the interest. But as an investor, you should know what are the factors or what are the things that we have to consider when we decide an interest rate, or what are the things that may have an impact on the interest rates. So we are going to look at that now. The first thing is real risk-free rate. What is risk-free? What does it mean? You give a loan, you have a guarantee, that 100% guarantee, the borrower will pay that back to you. There's no risk at all. Without any risk of getting that funds back, no other things, so you will get it back. What is the rate of return that you need? That is the risk-free rate. What is real? Assume no inflation, no risk. Then what is the return that you require? That is purely the sort of the consumption, foregone consumption. Assuming that even in the future, you can buy the consumption at the, or you can consume whatever good or the service at the same price in the future, and guarantee that you can get it. You will get that your funds in future, and you can consume that in future at the same price. So in that case, what is the return that you need? That is the real risk-free rate. Then, but in reality, the prices go up. It may not remain same. Probably prices are going up. So that is inflation in a way. So therefore, we need to add some premium to compensate that. What would be the inflation for a 1 year period? Then if you are to lend for a 1 year period, you add that inflation premium to the real risk-free rate. Then you derive the 1 year nominal interest rate. Again, still we think there's no risk. The counterparty or the borrower will pay it That is 100% guarantee. But again, in reality, we don't know what would happen in the future. Many things can happen. There's a risk that the borrower may not pay that amount, borrowed funds and the interest in the future. If you take 100 borrowers, not that all 100 borrowers are going to default. Maybe 5% is going to default. Say, assume the same type of borrowers, but still there's a chance that 5% will default. Then you add another premium for each and every borrower to compensate that loss. You distribute that loss among all other borrowers. So therefore you add a default risk premium. Then you forego your liquidity. Or in any if you had the funds with you in any emergency or anything, you have that liquidity. You can use that funds to buy something or to make a payment to something else, even to make a better investment. But by granting a loan, giving a loan, or making an investment, you give up that liquidity. You add that liquidity premium as well. Not only that, even the instrument that you buy or invest, it may be, you may be able to sell it in the secondary market in a future date. But what is the liquidity of that instrument in the market? Whether you can sell it easily in the secondary market, or it takes time. If you try to sell, whether there will be a reduction in price. Those things that you have to think. Then you add that premium into the interest rate. Then the last component, maturity. Because as I mentioned, the risk that you take if you invest for 1 week is completely different from if you invest it for 1 year. So based on the tenor of the product or the investment, you add another premium to compensate that maturity period. Likewise, these are the main components that includes in the risk-free, in the interest rate. So interest rate, you can see it as a sum of all these components. So I don't think I have to go through each of these slides because I explained those things, but this one, inflation premium. As I mentioned, once we add the inflation premium, that is the interest rate we call the nominal interest rate. So it is the nominal interest rate. Without interest, we call it is the real rate. It's not the real risk-free rate. Risk-free is something else. Real is something else. Without inflation, we call it as the real interest rates. Once you add the inflation component, then it becomes nominal interest rate. So whatever the interest rate that we quote in the market, we see in the market, all those are nominal interest rates. What you get on the investment or what you pay on your borrowings. Then the real rate would be decided based on the inflation prevailed during the period of your investment or the borrowing. If the inflation is high, real rate is negative. Inflation is low than the nominal interest rate, then the real rate is positive. Here, what I wanted to highlight is when the inflation and the interest rates are low, we can just, can you see the board? Can you see the board?
Yes, sir.
We can write nominal interest rate as the sum of real interest rate plus as the sum of real interest rate and the inflation rate. So the inflation premium. When the rates are small, we can use this. Indeed, this is an approximation, but the proper one is the 1 plus nominal interest rate equals to the product of 1 plus real interest rate into 1 plus inflation. So that's the proper way of usage. When the real rate and the inflation is very low, this would there won't be much difference between these two. But when these figures become large, there can be significant change, deviation. So, but now with the computational powers, now we have you can use this equation even in your day-to-day operations and when you deciding these things. Okay, the other thing, what is inflation? That is something that you have to understand. What is inflation rate? Now, what is the inflation in Sri Lanka?
Continuous increase in prices.
Sorry?
Continuous increase in prices.
Continuous increase in prices, inflation. Yes. What would happen if inflation decreases? Inflation reduce. What would happen?
Buying power increases.
No, buying power increase. No. What would happen to the price? What is this purchasing power mentioned here? What do you mean? Say, you have 100 rupees. You can buy something today by paying that 100 rupees. If the inflation is 10%, after 1 year's time, what would happen? The price of the same good or the goods, set of goods that you bought at 100 rupees has gone up to 110. Now, you cannot buy the same set of goods by paying 100 rupees, but still you have only 100 rupees. You had 100 rupees in your hand, you kept it for 1 year. Now you cannot buy the same thing that you could have bought 1 year ago today, because the now price has gone up to 110. That is the purchasing power. I saw the one of the news article, member of parliament explaining using coconut what is inflation. That's in a way it's correct. What you bought year ago by paying the same price, today you cannot buy it. Okay, now tell me, now the inflation is 10% here. If the next year inflation is 8%, what would be the price after 1 year? What is the price level at the end of second year? First year inflation 10%, second year inflation 8%. What is the price?
101.2.
Sorry?
101.2.
100?
1.2.
109.2.
1.
101.2. Any other answers? Any other answers?
118.8.
118.8. 118.8. Others, do you have any other answers? Others, what's your answer? Oh,
Same answer, sir. 118.8.
118.8. Anyone who is with 101.2? Can someone explain how do you get that 101.2? Now there are two answers. So okay, assume this is your paper. I can put it as so I put it as, assume I put it as a, in your paper appears a question saying at the beginning of the first year, the price is 100, inflation was 10%, and the second year inflation was 8%. What is the price level at the end of year 2? And 4 answers are given. Which one do you select? What's the correct answer? You came up with 2 answers. I added 2 more answers. Which one is correct? Now, those who have provided answers as 101.2 and 118.8, you should be able to defend the answer. Just explain me, how did you get this 101.2 and 118.8? So we'll discuss this. Then you'll find out. I'll explain how did I get these if necessary. But let's try to understand how did you get these two answers. And which one is correct and what's wrong. So out of these four, only one is correct, others are wrong. So we can discuss and identify what are where or what are the mistakes that we did. So can you explain how did you get this 101.2? So someone has raised the hand. So I don't know if it's now or previously. Whenever you have a question, please ask it. I may not monitoring these things. So if you have any question or any concern, please raise your voice and ask the question. Now, can you explain these two answers? How did you get that? What happened? So please speak.
So I got second answer 118.8 as first year it is 110. So on
No,
that
at the
second year I calculated second year interest rate on 110. So
this is the inflation, not the interest rate.
sorry, inflation rate. So then I arrived at 118.8. I don't know.
Sorry, yes, you take inflation as 8%. Then how did you get this 118.8?
On 110, when I calculated 8%, it
You mean
that
you
value
multiplied 110
into 8%.
8%.
Then
So
accumulated that
8% is
0.08.
0.8. Then you add that answer to
110.
10 again. So then you get 118.8.
Yes.
Correct. So how did you get this 101.2?
No, sir. The way I got it was wrong. What I thought was the second year inflation have gone down by 2%. So I thought the price should go down by 2%. So
2% or 8%?
2%. The first year it's 10%. Then second year it's 8%. So it's a 110 is the present price. And since the inflation have come down by 2%, the price of the product should go down by 2%. So then I thought 110 into 2%, it's 2.2. So minus 110, it has to be 107.8, not 101.2. I have deducted 8%.
Okay.
So when the inflation comes down, I thought the price also should come down by that percentage.
Exactly. That's what I wanted to highlight. In Sri Lanka.
Then the exact price should be 107.8.
Yes. In Sri Lanka, people think when inflation goes down, price goes down. That's how general public people think. That is wrong. What happens when inflation goes down? What is inflation? What's the inflation that you get? The definition that you gave to me. In technically we call it the increase in price level, general price level. So we have to define a basket or set of goods and services and weight depending on the consumption that we make or the money that we spend on one good. Say if we take 100 rupees, how much we spend on food, how much we spend on transport, how much we spend on our telecommunication, how much we spend education, things like whatever. So we give some weights and then decide what is the price of this basket and what would be the price of the same basket after 1 month time or 1 year's time. So for the simplicity, we'll take it as 1 year. Then, as I mentioned here, 100 at time 0, price 100, T equals 1 after 1 year's time. The inflation for this period is 10%. Then what is the price? What is 10% of 100? That is 10. So the price increased by 10. This is just the increase. But earlier it was 100. Then 100 plus 10. 110 is the new price. So that's why we call it, or the inflation is 10%. Now, if we see after 2 years' time, inflation or during the next year, inflation is 8%. What should be the price here? It should be again 110. The change in price, increase in price is 8%. So it comes as 8.8 rupees plus the previous price level 110, which becomes 118.8. So this is the price level, current price level. So the thing is, inflation is the inflation rate. This is the inflation rate. This is the inflation rate. We generally say inflation is 10%. Inflation is 8%. What does it mean? Mean the rate of price increase. So in the first year, price increased by 10%. In the second year, price increased by 8%. The rate that the rate that price increase has gone down, it does not mean that price level has gone down. Prices are increasing, but at a lower rate. When the inflation increases, prices are increasing at a higher rate. Did you get that? Increase in price and the rate of increase is two different things. If the price increase at 10% from the first year to second year, what should have been new price? If it was 10%. $121.1. Sorry, 121. But since inflation is 8%, new price level is 118.8. That's the first thing. Inflation is the rate of price increase. So if inflation decrease, it doesn't mean that price level goes down, but still prices are increasing at a lower rate. We have a separate name. If the price level goes down, that is we call deflation. Prices are going down, then the inflation is negative. It's not increasing, it's decreasing prices. That is deflation, which is not good for a economy in general. So that's the first thing that you have to understand. Then the second thing, I can explain how did you get that 101.2. 110 is into 0.8 is 8.8. What did you do? You deduct this instead of adding. Then you get 101.2. So you thought since inflation goes down, prices are going down by 8%. So you calculate what is the 8% amount and you deduct it. That's what you did. But remember, lower the inflation, it doesn't mean that price level goes down. For the time being, that's it. Is it clear? Any question on that? So default risk premium, I discussed that, equity premium, maturity premium. So now we'll come to simple interest. Is there any question before we move into this? Any question? No. Okay, then I'll explain this concept as well. What we calculated earlier, almost a simple interest calculation, where we started 100 rupees and 10%, we end up with 110. So instead of inflation, assume this is interest rate. 1 year. For a 1 year period, this is the interest rate. If you invest 100 rupees, at the end, you will get 110 rupees. How do you get that? First, you calculate 10% of the 100, that is 10 rupees. So this is the interest. Sorry, can you see the board?
So we can't see the board properly.
Better without telling that you could have waited until the end. How can you see that?
It's clear, sir.
Now it's clear, no? Okay. So 100 rupees, assume you invest 100 rupees today, and the 1 year interest rate is 10%, you know, at the end you get 110. How do you calculate that? You may know that, but let me explain. You can just calculate the interest component only. 100 rupees, 10%, or you can write this as 100 into 10 divided by 100. Either way, it's fine, but remember, if you use 10 divided by 100, because this is 10%, or otherwise, straight away put it as a decimal. So whatever, you get 10 rupees. This is the interest amount on. Then the maturity amount, full amount, we calculate it as principal amount plus interest. So we write it as T plus I. Invested amount is 100, interest is 10, 110. This is how we get this.
Yeah, I think you need to adjust the screen.
Why?
We can see right to left.
You see the reverse order as an image.
Yes, like ambulance.
Don't do that. No, I think.
So if we can change the layout, we can
Yes,
see it properly, sir.
It's from your side. You have to change your layout.
Yeah, because IBSL 2 participants are there. One is reverse side, and the other one is okay. So.
Can you explain how someone can switch it?
Yes, please.
Sorry, can you explain how to switch it, please?
So there's an option to change the layout, the icon before the end call.
Before the end call, there
are 3 dots.
3 dots. Click on it.
That's a change layout.
Change layout. Okay. So I'm not going to change that. So others, did you get it?
So that you can see other participants as well. In that, there's a 2 IBSL screens, you can see it. So one would be the mirror one, and the other would be okay, the proper screen.
Select this. This is not what you see. No? This is
yes. Yes.
There are 4 options.
There are 4
screens, right?
Sorry.
When you see the participant list, there would be IBSL online presentation and the IBSL online. So IBSL online presentation would be the reverse one. If you select IBSL online, you can pin it.
Correct. Okay. Got it. Stop. Then the mirror make a change. Is it okay now? Have you got the correct view?
Not yet, sir.
Not yet. Okay, let me change it.
Just pin it and say pin the screen, then it will be okay.
Now how is it okay now? Can you see the correct view?
Not yet. So now okay.
Now it's showing. Okay, okay, thanks. So we'll move it. So is it clear, this calculation? Any question on this? So this is the simple interest calculation. I'm pretty sure this is not the first time that you learn this thing. Even you ask grade 7, 8 student, they will do this calculation, correct? So, but I want to show you, if you want to calculate the interest component separate, yes, you do this way. And if you want to get the maturity amount for that, what would you get on the maturity date? You have to add the principal into the interest. But you can do this, you can get this amount in a one go. How do you do this? If I write it as T plus interest is the principal into interest rate. So I can take out the principal component. Then the equation would be something like, so the equation is P times 1 plus interest. So then you can get the maturity amount in one go. So that is one thing you can do. So if you apply that to this problem, you can calculate the maturity amount for the maturity proceeds as, what is the principal? 100 into 1 plus, what is the interest rate? 10%. Remember, either write it as 10 divided by 100 or 0.1. So this would become 100 times 1.1. So you will get 100. Okay. That is simple interest calculation. So is it clear? Any question? Is there any question? Is it clear?
Yes, sir.
Yes.
Okay. But remember here, in my example, I take that interest rate as the 1 year interest rate, and I calculate the interest for the 1 year period and the maturity amount for the maturity proceeds at the end of the 1 year period. But assume you want to calculate it, say your deposit or whatever, it is only for a 6-month period. Then how do you calculate? What's the interest amount? If you want to calculate interest for more than 1 year, then how do you do? Do you have any idea? Interest rate is 10%, but your deposit or the borrowing is only for 6 months. Then what is the interest amount and total proceeds for the maturity proceeds. How do you calculate that? Do you have any idea what to do? So we'll come to that later, but think about it. Huh? As bankers, you take deposits for short periods, then you calculate interest. How do you do that? You have a system, yes, but you should know what is behind that system. So calculating simple interest, this is the way. Interest is the principal amount, interest rate. Here I have used different notation. This R is the interest rate and time. When you have a time period, you multiply it by the time period. That's how we calculate. As a simple example, we'll do this. Now I think you should be able to do this. If you invest 10,000 rupees at an interest rate of 4% annually for 1 year, the interest on the investment can be calculated as follows. So can you do the calculation then? Let me know the answer. Or do I have to do this?
Sir, 54.24.
Sorry?
54.24. 6-month interest.
50 to
4.24.
54.24. Is it correct?
Sorry, sir. Sorry, sir. It's 4.93.
4.93.
Yeah.
How do you get it? Principal amount is 10,000.
Yeah, interest is you get 1 year interest is 10 rupee. 10 rupee divided 365 into 180.
How do you get that 10 rupee?
It's a 1 year interest.
10,000. Interest rate is 4%. So 4 divided by 100 for a 1 year period. So multiplied by 1. What's the answer? Any other answers?
So 400.
400.
4,000 at the maturity, sir. Interest.
Sorry. Interest?
Interest would be 4,000 at the maturity. Total would be 14,000.
Interest is 4,000. Not 54.93. Okay, we have two answers. Here the question is interest only. So what is the interest? Is it 54.93 or 4,000?
400, sir.
4,000. So if this step is correct, the answer is
400.
Answer is something wrong. What is the answer?
400.
So
400.
then you get
Sorry, sir, it's 400. I thought
400.
10 years.
Answer is 400.
Oh, 400. So the correct answer is 400. These two are incorrect. So go back to basic. Do it. So now you can realize what are the mistakes that you did. I didn't get that. Someone explained that how to get this 54.93. I didn't get that. But if you want to, you can explain it, and I'll tell what is wrong in that. This is simply a calculation error, I guess. This is the correct answer. This is a very simple thing. It's not a difficult calculation. Is it correct? So I'll delete unnecessary answers. Then it's easy for you to so this is the answer. Correct? Any questions on that? I think the 54.93 answer is for my previous question on the board. If it is for 6 months, is it? Someone said the answer is 54.
Yeah, sir. Yes, sir, it's my mistake. Sorry.
4.93. This may be the answer for this question. If it was 6 months at 10%.
Yeah. Yes, sir. Sorry, sir.
Okay. No problem. No, we will. Okay. How do we do that? That's the thing that we have to do. How do we calculate that? We'll go back. Go to this one. That one. Yes. We'll go back to the board. Can you explain how did you get that 54.93? What is the six month interest? How did you get that? Can you explain? Can you explain that, please? Still, there may be a mistake, I think. Maybe 4,000 rupees. 4,000 rupees. Yeah. Okay. Assume 100 rupees. Let me know how did you get the answer.
So 100 into 10%.
100 into 10%.
Divided by 2.
Divided by 2. That means multiplied by 5. Is it correct? Then you get 5 rupees.
5 rupees.
Is it correct? So do you have any other answers? The one who got 54.93, he had a different explanation. I would like to hear that as well. Can you explain? So I suppose this is 4,000 rupees, 400 rupees, you should get 5.43. So 93. Can you explain how do you get this?
So it should be a 4.93.
4.9.
Not 54. Yeah, yeah.
Okay, whatever. Forget about the final
Yeah.
answer. Explain me the
Finally,
mechanism. How did you get arrived?
Finally we get the at annually 10% as an interest.
Okay, shall I delete this? Now this is clear. One day you will get. What did you do? You calculate annual interest. Is it correct?
10
into 10%. So you get 10 rupees. Okay.
Yeah.
Then
Divided 365.
So then you calculate
Daily interest.
Daily interest. So 10 divided by
365. 65 into 180.
Then 6 months. 10 in 3 divided 365 into 180. Maybe you get 4.93. I don't know the calculation. Yes. Okay. Now you have two answers. One is 5 rupees. The other one is 4.93. Which one is correct? Oh, both are correct or both are incorrect? Assume again, this is an MCQ question. There are MCQ questions in your exam as well. I pose this question. So I assume you invest 100 rupees at 10% interest rate for a 6-month period, and the interest that you get at the end, answer A, 5 rupees, answer B, 4.93 rupees, answer C, both above, answer D, none of the above. Now what's your answer?
Answer C is right. So it depends on the institution which
Answer C is
yeah, it depends on the institution, the method of calculation. Some institutions take it 364 basis and some takes it 365 basis, and since it's simple interest, you can just take for number of months, like 12 months, and divided it by 2 and 6 months.
Correct. That's the thing. So if I ask how many number of days per year, what is your answer? How many number of days?
In treasury calculations, they take it as 364 basis. Even the treasury bill calculation goes as 364 basis, sir.
Treasury bill calculation, we use 364.
Yeah.
In other calculation?
Most of the time, it's 364 basis.
Okay. Yes. So if I ask that question, how many days per year from a school child, grade 5, 6, or somewhere, what would be the answer?
365.
If it is not a leap year, that would be the answer. But as you quite correctly mentioned, when it comes to the financial market, there's no definite answer. Whether it's 365, 364, even 360, 360, 364, 365, all are possible. So we have a separate session on that. We'll come to this later. And if I ask you in this calculation, you took 365 as the number of days per year, then why did you take 180 as 6 months? That's another thing. So here, these options are available to count the number of days per year. That's fine. Then how do you calculate the number of days for a 6 month period? Why it is 180? In our treasury bill, it is 182 days maturity. But we discussed just few minutes back. Maturities are 91, 182, and 364 days. Then 6 months would be 182. Why do you take it as 180? Or can it be 181 or 183? Is it possible? So these are the things that we have to consider when calculate interest, especially in the money market. So we have a session on this in the future. So therefore I'm not going to explain it now. Then we will move focus away from this our topic. But remember that has to be considered. But for the time being, we'll go ahead with this calculation. So if it is full years, no problem. You can just multiply it by the number of years. Clear? So we'll come to the interest calculation, simple interest calculation for less than 1 year period later. So then the next one is compound interest. What does it mean, compounding? You calculate interest on interest. That is called compounding. Is it clear? You calculate interest on interest. That is compounding. Let me explain that concept. You can see somewhere here. Say you invest 100 rupees for a 4-year period. Sorry, we'll make it 2 years. Make it easy. At 10%. You don't collect interest at the end of the first year. What is the total interest that you get at the end after 2 years? So what is the total amount that you get at the end? Can you calculate it? How do you do that? Time 0, time 1 at the end of the first year, and then end of 2 years. You invest 100 rupees, interest at 10% at the end of 1 year. What's the interest amount that we get? It is 100 into 100.1. 10 rupees. Then what is the what is our sum? We invest this interest and the capital for the principal amount at the end of the first year. Then we invest that at 10% for other year. The interest for this 10%. What is the interest amount? 110 into 0.1. 11. Then what's the total? What's the total interest?
121.
21 rupees.
That's another problem. Yeah. So either you in the question properly, or in the exam, or when you read the question properly and understand the question, then answer the question, not the thing that's in your mind. What was the question? What is the interest?
21 rupees.
21 rupees. 10 rupees plus 1 rupees. 21 rupees total interest. What is the total amount?
121.
That is 121. Okay. This is the concept behind the compound interest. But if I ask, this is for 10 years, not for 2 years, for 10 years. How do you do this calculation? Are you going to do this, repeat it for 10 times? Or if it is 30 year, 40 year loan, are you going to do that, repeat that? How do you do this? There's a simple thing. Indeed, you invest 100 rupees and after 2 years, you get 121. In our jargon, we call this is the present value. This is the future value. So with compounding, how do we calculate this future value? Is the present value times 1 plus interest rate to the power n. N is the number of terms. In our example, in the previous one, what we worked out number of years, 2 years. There's a reason why I write it as terms without telling number of years. I'll explain it on a further maybe next week. But remember, this is number of terms. How many interest periods? It may be in years, it may be in quarters or something like that. But for the time being, you can remember it as number of years. So if you work out previous example based on that, future value would be 100 into 1 plus 0.1 to the power 2. You should get 1 when you do the calculation in a calculator. 100 into 1.1 to the power. Okay, so this is the equation you should remember. So if you do a lot of calculations and sums, this will register in your mind. No need to put some extra effort to remember this equation. Have you noted down this? Is it okay if I cover it? Any questions? So this example in the handout, that is 10,000 rupees, 4% for 3 years. So you can use the same method, but here for the calculation of interest only, first you have easy way is to find out the full amount first and then deduct the principal, then you get the interest amount as the answer. But going forward, mostly what we bother about the full amount, not the interest itself. So any questions before I move into the, I'm not going to start the next part today, but this is the basic, this equation. And especially this part, the future value. So that's the basic that you have to remember when you come to the next week class, because next week you can see we are going to discuss how do we use this equation when the compounding frequencies are different, that is not annual. It can be semi-annual, quarterly or monthly or daily, any times per year. So how to do that, we'll discuss that next week. So we'll stop here today for today, but before we stop, would like to know whether you have any questions. If you have any questions, please free to ask. Still only 20 people has responded to the survey. So please respond before next class. This is good for you. Huh? So okay, if you don't have any questions or any comments, shall we wind up? Any comments or any questions, or shall we wind up?
Sir, I have a doubt. I am unable to fill the forms. They asking for the permission.
No, that's the thing. You have to log into the Google account using the IBSL email address.
Yes, I logged in, sir, but I am unable to.
Still you can't.
Yes.
You use that ibsl.edu.lk.
Yes, sir. Yes.
Okay, let me check. Keep trying. If something
Okay.
we need to do from this side, we'll do that. When you click on the link, is it asking for a permission?
Yes. This form can only be viewed by the users, only owners or organizations.
Users or owners. Okay, we'll check it.
Okay, sir.